this is Mirov Paps from the Edison Group. I would like to welcome Gauld, who is Senior Investment Director and Lead Investment Manager at Aberdn Private Equity Opportunities Trust. Thank you for joining us today.
Thank you, Milos. Pleasure to be on your show.
Maybe you can start by providing us with an overview of the company's investment strategy for those investors who are less familiar with the company.
Sure, absolutely. So Aberdn Private Equity Opportunities Trust, or APEO as we call it now, is focused on mid-market private companies in Europe and has been since 2001. So we define mid-market as businesses that are valued between 100 million and a billion enterprise value at entry, and typically invests behind buyout transactions, which is where a lead private equity investor has majority control and APEO partners with them. So APEO invests through funds, backing the private equity managers as a core relationship with, but also through co-investments, which are direct investments into the underlying private companies. And as I said, it backs a small group of private equity investors. So there's literally thousands of private equity firms that you can partner with, and APEO partners with 13 core relationships in Europe. This is obviously a closed-ended vehicle, so it's evergreen. So it's really about balancing the cash flows, the drawdowns and distributions and new investments that the trust makes. And we've got experience of over two decades doing that. But lastly, I would call out the performance of the trust. So over its 21 years, it has an annualized NAV total return of 11.6%, which is outperformance of the FTSE All-Share. And in fact, across all time periods, it's outperformed. Last year was a record year in terms of NAV growth, so it's 37.9% NAV total return. And so far this year, in financial year 22, for the first 6 months, the trust has grown 6.8% in terms of NAV total return.
Thank you. That's very helpful. Now, private equity is considered an alternative asset class, which is lesser known to some investors. Why do you think should investors look beyond public equities and expand their portfolios to include private equity investments?
I would say, well, it's multifaceted, but really the first element to this answer is probably the fact that companies are staying private for longer. With the growth in private equity, private companies have access to capital for much longer than they did in the past. So you've seen a number of businesses become multi-billion in size, and then list when they're worth tens of billions, whereas maybe 15, 20 years ago that wasn't possible. And that has the advantages for private companies that there's less red tape. They don't have the quarterly reporting cycle, for example, to undertake, and they have an active owner that sits alongside them on the board. So from an investor point of view, if you want to access many of the market leaders, particularly niches and businesses of the future, private equity is probably the main way to do that now. Secondly, I would say that the part of the market that APEO focuses on, the buyout market, is really, it's about taking majority positions in businesses and being an active owner. And this governance model, I think, is underappreciated in the market. With private equity able to sit on the board and really drive performance. And I would say private equity firms have got a lot more specialist over the last decade, a lot more focused on sectors, sort of being focused an inch wide, a mile deep, and really knowing the subsectors that they have a strong track record in and strong knowledge, and can be a differentiated partner for companies. So they add so much more operational value than perhaps they did 15 years ago. So I do think this is underappreciated, and this is an element which allows private equity firms to act decisively and accelerate growth in their underlying businesses. Thirdly, I would say private equity, from an investment point of view, provides diversification in your portfolio. So there is some correlation with public equities for sure, but it's not as correlated as you would think. We did an analysis a couple of years back and tracked the data from 2002. and it suggested the correlation was just over 50%. So there's diversification benefits as well by investing into the asset class. And then finally, I would say, looking at present at the investment trust world, currently the discounts to NAV are very, very wide, on average around 40%. So I do think it is quite an attractive entry point if you're a long-term investor, and that, we believe anyway, that's the way that private equity should be considered as a long-term asset class, given funds are 10 years, investment hold periods are typically 4 to 5 years. So if you're looking to invest in this asset class over the medium and long term, I think right now is quite an interesting entry point.
Thank you. And can you also talk us through the positioning of your portfolio for a recessionary scenario in terms of your sector exposure, as well as liquid resources you have at your disposal to finance new investments?
Yeah, first thing I would call out is that the trust is well diversified. So it has over 600 underlying companies, and our largest single exposure is 4% of NAV, and most companies are less than 1% of NAV. And the portfolio is very well balanced by sector. Our largest sector is 21% of the portfolio, which is technology, and most of our technology exposure really is in B2B profitable software businesses. So the area that's probably been less hit in the public markets recently. We have very little exposure to high cash burn growth type technology businesses. But really, aside from technology, pretty well balanced across healthcare, industrials, consumer, financials. Those would be the key areas I would call out. In terms of geography as well, we're well balanced across North America and Northwestern Europe. Our two largest regional exposures are, somewhat ironically, given that this is focused on Europe, but North America at 21%, and the Nordics actually, pretty stable economic region, at 17% of the portfolio. And in terms of maturity as well, we don't try to market time in this particular trust. We generally kept deployment quite stable over a long period of time. So if you have a bad vintage year, take for example 2007, just before the GFC, it gets offset by the good vintage years, like 09, 10, 11, 12 in this particular example. So we have around 50% of our underlying companies that have been held for 4 years or more. So that underpins good cash flow back, because typically private equity investments are held for 4 or 5 years before exit. And with very little concentration around the private equity firms we back, the largest relationship we have in terms of percentage of NAV is around 12 or 13%. So you get that diversification at a manager level as well. So that's the first thing I would call out. And really, I think that it's worth pointing out at this stage that we are backing, as I said earlier, a small group of institutional best-in-class managers, that have that sector expertise, where we've had a relationship for around a couple of decades. So I think we're doing a really good job at picking managers, if I don't say so myself. So if we look at our track record, around 3/4 of our picks in the last 10 years and 20 years have been top or second quartile when benchmarked. So that gives us a lot of confidence when we look ahead. And these managers themselves have been backing typically high quality businesses, often market leaders with strong characteristics around recurring subscription revenue, around high margins, pricing power, and free cash flow. So that gives us a lot of confidence when we look ahead that we've been backing these A+ assets. And leverage, when we look now compared to maybe the last major dislocation sort of in the global financial crisis, leverage is much lower in our portfolio than it was. I think our top 50 assets are just over 3.5 times EBITDA in terms of leverage, which sits below the market average, which is above 4. And these debt packages, I think, as well, are on much more flexible terms than they were back 15 years ago. You know, covenant light packages, covenant loose packages are commonplace now in our portfolio. So again, we think there's more flexibility at an underlying level and more pricing power as well. But relating to your point, Milos, around, you know, our resources, we feel again our balance sheet's in a good position. At the moment, we've got about 175 million of cash and undrawn debt facility, which equates to around a year's worth of drawdowns. Now, drawdowns are, you know, correlated with distributions. So, you know, typically they're both very closely linked to private equity activity, deal-making activity, but there is a lag. So we like to keep, you know, sort of around a year's worth of forecast drawdowns up our sleeves in case there's you know, a very pronounced dislocation in the market. But in addition to that, you know, we do have long-term supportive lenders there as well. So we could look to do something with the debt facility, increase that over time. In addition, we could always look to sell opportunistically some of the older exposures that we have, more long in the tooth exposures on the secondary market. The secondary market has increased in size 5 or 6 times since 2007. So it's much more liquid, and you can typically get or sell a portfolio in a sort of a time window of around 3 months. So we could look to do something like that to create more firepower for new investments. But at the moment, we're not planning that, and we feel like we're in a good position.
Thank you. And what near-term investment opportunities do you expect in each of the main private equity categories, that is primaries, secondaries, and co-investments? You've touched on secondaries. Have you seen any additional selling pressure in the secondary market to potentially allow you to buy quality assets at discounted prices?
Yeah, so let's start with secondaries. I do think this will be an area that will be a bit more active in compared to prior years. So secondaries obviously being, you know, buying a fund or a single asset part of the way through its, you know, hold period from another investor. And for us in recent years, it's been quite tough because, you know, we've been backing high quality private equity funds. Typically, people haven't been selling as much, and those types of assets, when they've come to market, have typically commanded quite high premiums, shall we say. So it hasn't really worked out from a sort of a risk return perspective. But now we think that with the way that public markets have re-rated, there'll be the denominator effect with certain private equity investors where they look to kind of release some of their private equity portfolio to address that impact. There may be some distressed sellers. We're not yet seeing this, to be clear. You know, the volumes in the market to us, and we're starting to get a sense there's more deals coming through, but we really haven't really seen an awful lot of momentum just yet. We feel that people are maybe waiting for the June valuation cycle to kind of pass through and probably have a better idea of how assets are valued before selling a portfolio or indeed buying a portfolio. So certainly an area we think over the short to medium term we'll see a lot more activity in, but just not quite yet. Possibly as we move into Q4, we might see volumes pick up. But in terms of the other strategies, I mean, primary funds, which is committing to a fund on day one of the fund's life, we don't really see any change to our strategy here. So as I mentioned earlier, we're looking to back long-term relationships of ours, you know, managers that are sector specialists that can do a lot of heavy lifting and add a lot of value over and above company management's plan. Those are the type of managers we want, and typically moving a little bit lower down the mid-market where we feel, well, where less capital has been raised proportionally compared to the larger end of the private equity market. So none of that has changed, and we'll continue to deploy around 20% of NAV a year into primaries. As I said earlier, we don't try to market time, we try to maintain that consistent deployment. And we'll continue to grow our co-investment portfolio. We introduced co-investments into the investment objective in 2019. and it's going very well. We're very pleased with that, and co-investments bring the advantage of often having no fees or carry attached to them, or at least reduced fees and carry. So the potential is there to generate higher returns from co-investments. So far, co-investments equate to around 17% of NAV, and we have 22 underlying co-investments there. I would guide you to co-investments becoming a portfolio of around 30 underlying investments, equating to around 25% of NAV. So we're very pleased with how our co-investment portfolio has started, and expect that to continue to grow.
Thank you. That's very helpful. Now, private equity fund of funds receive the valuations of their portfolio holdings from general partners with a certain time lag. As a result, last reported net asset values of many private equity fund of funds are still largely based on portfolio valuations at the end of March. When do you expect to receive the portfolio valuations at the end of June?
Yeah, so there is a time lag in valuations, just due to the nature of private equity and the reporting. I would expect the vast majority of valuations to be based upon 30th of June by our August monthly NAV statement, which is released in the middle of September. So by the middle of September, we should have a very clear picture of how June valuations have impacted the portfolio. Obviously, public markets fell quite dramatically in that quarter, particularly indices that had a high technology exposure and growth exposure as well. APEO's exposure to high growth equity, high cash burn businesses is minimal. I'd estimate less than 5% of NAV, and its 21% technology exposure, as mentioned before, is largely in profitable B2B, highly embedded businesses. So, we feel very comfortable with that exposure. From what we've seen reported in the market so far by other firms, it does appear like it will be a more difficult quarter than we've seen in recent past, and it's not surprising. But from some of the firms that have reported publicly, we have seen some bright spots. For example, 3i reported another uplift in Action, which is our largest underlying portfolio company, 4% of NAV. So, we expect to see some bright spots, but how it all shakes out, we're not quite sure yet, but it's certainly been more difficult than we've seen in the recent past.
Perfect. And finally, can you shed some light on the dividend outlook for the company?
Yeah, absolutely. I mean, APEO has a progressive dividend. It has had that since 2016, and we attempt to maintain the value of the dividend in real terms. It's paid quarterly and currently offers a yield of around 3.5%. So historically, we increased the dividends by 3% per annum, ahead of inflation at the time. At the start of this financial year, we increased it by around 6% to reflect inflation expectations at that time. Obviously, inflation has moved since then, and so given that evolution, we'll monitor this pretty closely and reflect the current conditions in future dividend payments. So, yeah, that's it.
Thank you. Alan Gauld, Senior Investment Director and Lead Investment Manager of Abrdn Private Equity Opportunities Trust. Thank you so much for your time.
Thank you, Milos. Great to be on your show.